Hey everyone, welcome to another live stream. Today we are talking about how the real estate market is locked up. It's frozen. It's going to be locked up for a little while according to the two articles we have to go over today. And a lot of that has to do with the two things that we've been talking about for a little while now, interest rates and housing supply. So we've got a great stream in store for you today. We've got a couple articles and a couple videos to go over, and we're going to be talking about how the housing market is not getting any more favorable for buyers out there, and we're at a little bit of an interesting spot, especially as we are in the thick of the buying and selling season, the prime summer months. So we're going to start talking about things before we get into that. Thanks for joining me on the stream today. I hope you're having a beautiful week, and I hope you're gearing up for a great 4th of July if you're watching from the United States. My name is Joe Pareca, and I'm a local real estate agent here in the Los Angeles area. I'm in East Los Angeles County in the San Gabriel Valley area, and welcome into the stream. We're going to jump into the topics right now. At any time, if you guys have any questions about anything, or if you're watching on the replay and you have any questions about anything that's in the stream, anything that's in the articles or the videos that we watch, drop it in the comments. Also, I'd love to know your opinion. What do you think about the stuff in the articles? Do you think the housing market's locked up? Do you think it's going to be locked up for a while? Are we headed for a crash? I'd love to hear from you. And as always, if you like the stream, please drop a like on this video. Consider subscribing to the channel. It really helps me out. So let's get to it. All right. So we're starting off with an article from realestatenews.com, and this is basically just sort of a housing market decoded, the mortgage rate lock-in effect. So we're going to be talking about how the housing market's basically it's locked, it's handcuffed, and a big reason for that is the inventory crisis, which is linked to the lock-in effect of mortgage rates. So first, we're going to talk about what that is and how that's affecting things. And then from there, we're going to talk about what we think the market might do and what we're seeing going on kind of just all across the nation. So housing market decoded, the mortgage rate lock-in effect. Rates have gone up considerably in the past few years, but is the fear of losing a low-rate mortgage really keeping homeowners from selling? Spoiler alert, the short answer is yes, absolutely, it is. So this is written by Lisa Stewart Avant and from realestatenews.com. So this is her take on the mortgage rate lock-in effect. This is a good article. I already read this before a little bit earlier. It's got a lot of good material in here. Decisions in residential real estate are often based on market data, sometimes conflicting, often confusing. Housing Decoded, authored by economists and other market experts, helps with the data in context so you can make sense of the numbers. So pretty helpful. A recent report by the Federal Housing Finance Agency concluded that the mortgage rate lock-in effect prevented 1.33 million home sales that otherwise would have occurred if homeowners had listed their homes for sale. 1.33 million is a lot. With sales last year at a near 30-year low, that is a big impact on the market, which it is. We're at a time right now where really every transaction is needed. And when I say every transaction is needed, and we'll get into this, it's a chain reaction event, right? So if I were to sell my house to move up to a larger home because say in the instance my family is expanding or something like that, then someone can move up into my home. That makes a house available for sale, which is probably smaller, more affordable than this one. So someone buys that, then their starter condo is now available for someone to buy. Someone buys that. Maybe they were renting in a small apartment, they bought their first condo, and now there's an apartment up for rent for someone new to rent that. So it's a chain reaction. So right now we need all the transactions we can get to help keep that chain reaction going, because right now that chain reaction has been severely impacted by the low inventory and the high mortgage rates. The lock-in effect refers to the reluctance of homeowners to sell their home when they have a very low mortgage rate that they would have to give up, often to take on a mortgage with a much higher rate. Rate lock has been touted as the primary reason why there have not been more home sales transactions, which is probably correct. We don't have a whole lot of houses. Supply is an issue. Demand is still good, and I don't blame people that are suffering the lock-in fate. If you've got a 2.5%, 3.5% rate, really honestly, if you've got a rate around 5% or lower, unless you really have to sell a house, or there's a circumstance in your life, perhaps there's been, like I said, maybe your family's getting bigger, maybe your family got smaller, maybe there's divorce or something, or you get relocated for work. So if you have those types of situations, then sometimes you have to sell and you have to move. But for a large majority of the people out there, they're not interested in giving up their 2, 3, 4, 5% rate just because in order to inherit a 7% rate. Let's do a little math. Math doesn't lie. If a family purchased a $300,000 home in January of 2021, which as a sidebar, wish we could, I'm sure we all want to go back in time and buy a house in January of 2021. uh, in January 2021, when the average mortgage rate was 2.65%, they would have a monthly payment of about $1,500. Fast forward to April of 2024, when rates were at 7%, more than 400 basis points higher, and the monthly payment on that $300,000 home is now $2,225, a nearly 50% increase. And that's thanks to mortgage rates. And in the video that we're going to watch a little bit later on, the guest on that, which is a guy named Kevin O'Leary, obviously a big time finance guy. He's on the show Shark Tank. He basically said mortgage interest rates, that is the problem facing Americans in home buying. And I don't disagree. Obviously, the prices of the homes are high, but that's kind of connected to interest rates because people aren't moving because of this lock-in effect, because those rates are so high. If people aren't moving, houses aren't coming out of the market. Therefore, supply stays low. Therefore, prices stay high. So it is certainly connected. So, man, 50% increase in just 4 years in monthly payment is astronomical. It's unreal. It's not sustainable. And I can see why there's a lot of Americans out there that are feeling very frustrated with their inability to afford a basic home. I mean, at this point, $300,000, that's not even the median price in the United States. So, in fact, it's kind of decently below, because last time I looked, I believe the median price for a home in the United States is around 450, 460. So that's a fairly affordable home by the metrics, and man, a 50% increase to 22, 25 a month is a lot. But rates are not the only thing to rise during that period. Prices also went up, which, again, for those of you that are newer to kind of the real estate thing, typically when interest rates go up, prices tend to come down, and the inverse is true. When prices go up, interest rates tend to go down. Not in this case. Not in this case. We had a very interesting sort of occurrence where interest rates went up and prices continued to go up. Very, very rare phenomena. If that family wanted to sell their home and purchase another home, the median sale price is now $400,000, which means at a 7% rate, they would be looking at a monthly payment of $2,900. So if this family bought a home in January 2021, they're looking at $1,500 a month for their mortgage payment. Now, if they bought the same median priced home, they're looking at $2,900 a month, which is an over 50% increase. Crazy. Anyone who bought or refinanced when mortgage rates were very low is facing a similar math problem, and that group of homeowners is large. About 70% of all mortgage holders currently have a rate that is more than 3 percentage points below today's average rate. So that would basically put it at 4%. It was kind of phrased a little bit awkwardly. They should have just said 70% of mortgage holders have a rate below 4%, but that's okay. This is a really important couple sentences here, and I'm going to explain why. So when we talk about you hear people talk about there's going to be a housing crash. These probably the rate, the increase in pricing is unsustainable. There's going to be a housing crash. The prices are going to fall out. This is a great reason on why they're not going to. 70% of all mortgage holders have a rate under 4%. 70% of all mortgage holders didn't pay astronomical prices for their home. 70% of mortgage holders have a very reasonable mortgage rate, which means they have a very reasonable payment. So 70% of homes out there, very, very affordable to people. I mean, the only thing that would cause a major issue is if we had huge catastrophic job loss, which by all metrics, people are working. They're working multiple jobs. They're working quite hard. So it doesn't seem like that's going to happen. And that's also not taking into account of the 70% that have mortgages below 4%. How many of those owners don't have a mortgage at all? So again, there's a lot of people that are boomers, the boomer society, older people. They don't have mortgages. Their homes are paid off free and clear. So this has come a completely moot point to them. And again, we've talked about it on the channel. We've talked about the boomer debt and the silver tsunami. If you're interested in that, you can go take a look at my past live streams. You can watch those. We cover that topic expansively, and we talk about how boomers could affect the market in the next 5 to 10 years. So the numbers send a very clear message. Selling does not make sense for most homeowners when this is their bottom line. There's more to selling a home than math. How do we explain then the steady increase in new listing activity over the past few months? Which is true. We've had a little bit more activity depending on where you are in the nation, still probably below average in terms of inventory, but there definitely has been an uptick. I can tell you that firsthand. I'm in a pretty hot market. I'm in East Los Angeles County, a town called Claremont, California, about 40 miles east of downtown LA. And we're a pretty hot market. We have a lot of people moving from the sort of metro LA area out here because it's more affordable. And we have seen a rise in inventory. Specifically, we've seen a rise in inventory in luxury property. So that's property in our area that's 1.5 million or more. So there has been a steady increase in listing activity. The number of new listings coming on the market has been on the rise since January. And in April, according to Altos Research, which is a major and reputable research company, new listing activity not only surpassed last year's level, but was higher than during the pandemic. Now, it's important when you hear things like that, listing inventory is higher than it was a year ago, or is up 100% over a year ago, or is higher than it was during the pandemic. You have to remember that those years are, we call them unicorn years for a reason. Inventory was very, very, very low. We've talked about this before. If I have $1, now I have two, that's a 100% increase. Okay, well, I'm still not rich. But if you went from $100 to $200, well, now it's a little bit of a noticeable difference, right? So it's important that when you hear data phrased in this term, especially when we're talking about housing prices, housing inventory, days on market, really anything related to the housing market, you also have to keep in mind that for the last 2, 3, 4 years, it was bottom of the barrel. It was super, super low. Any increase is going to look like a big increase. The answer is that even though buying and selling a home are huge financial decisions, they are not solely financial decisions. A few other numbers can help shed light on why more homeowners might be selling in 2024. First, some people have to sell. That's kind of what we were talking about earlier. Death, divorce, new baby into the family, or a couple new babies, job relocation. There's tons of different reasons where people, they're not choosing to move, but they have to move, so they're going to. In Bright MLS's recent surveys of sellers as agents in the Mid-Atlantic, about 14% of listings are estate sales where family members are selling because the homeowner passed away. Health concerns also necessitate selling. About 17% of people selling their primary residence listed their home due to health reasons. And that's not uncommon. Again, we have a large baby boomer population. They're aging, they're getting older, they're passing, although they are living longer in comparison to generations previous, and they're living longer at home. Unfortunately, they're still passing, and their houses are going to be coming up for sale. So again, that's a great example of people that have to move. Now, if someone is passing because they lived in their home, there's a good chance they don't have a mortgage on the property and it's owned free and clear. So, interest rates aren't really of a concern to them. But again, it just goes to show you that every once in a while, you gotta sell, you gotta move. But the main reason people are selling now is the same as it has always been. Changing family circumstances, like getting married or divorced, having children, retiring, and are driving homeowners to list their home, even with rate lock looming. Our survey data indicates that more than 1 out of 5 homeowners are selling for family reasons. It's 20%. It's a pretty big number. They're selling for family reasons. So what does it all mean for inventory in 2024? While the gap between current and past rates will continue to keep some homeowners in their homes and inhibit supply, the inventory picture in 2024 will not be driven exclusively by the rate lock phenomena. Expect demographics factors, including death, retirement, marriage, and children, to bring more listings onto the market as these life happens events unlock the the rate lock handcuffs for some families. So, kind of an interesting article here. You know, again, basically, it's just talking about how what rate lock is, and the fact that it won't lock everyone in all of the time. So I want to go to the next article, and this one is really the one that I wanted to kind of cover the most. Let me scroll up here. Get to this. Okay, so here we go. This is from CNN. The housing market is stuck until at least 2026. Bank of America warns. Now, whenever you see these types of headlines, I always get interested by who is taking the position. Last week we covered an article where another, like a real estate YouTuber that sells like a real estate course online took the position that the housing market was going to crash in Texas and in Florida. That is one of those things where it's like, okay, so one dude is out there trying to build revenue, off his real estate information sales, not super credible. This is Bank of America. So Bank of America, although it is a large corporate bank, obviously they've been around for a while. They've been through some cycles, both business cycles and housing cycles. They probably have a good idea of what's going on. So let's jump into this article about why the housing market is going to be stuck until at least 2026, according to B of A. New York, help may not be on the way for first-time homebuyers frustrated by high mortgage rates and even higher home prices. Economists at Bank of America warned this week that the U.S. housing market is stuck, and we are not convinced it will become unstuck until 2026 or later. So interesting prediction here. Doesn't sound like Bank of America thinks that buyers are going to get any relief anytime soon. And unfortunately, I tend to agree with this article, and I'll tell you why as we go through it. As always, if you're watching in the stream, comment below. Let me know where you're watching from. I'd love to know what you're seeing in your local marketplace. Let me know if you have any questions. The bank said home prices will stay high and go even higher. Sorry, buyers. The housing shortage will persist. Mortgage rates may not fall much, even if the Federal Reserve finally delivers long-delayed interest rate cuts, which is a good point. We were supposed to get 7 rate cuts at some point this year. We haven't gotten any, and I don't know if we will get any. There's been some rumors of possibly a rate cut in September, but it's really hard to know, and it's quite possible that it won't happen at all, especially since we have some pretty sticky inflation. The bank said home prices will stay. Oh, we already covered that. This will take many years to work itself out. There isn't a magic fix. Michael Gapin, head of U.S. economics at Bank of America, told CNN in a phone interview. The message for first-time buyers is one of patience and frustration. Housing affordability is a major problem in America. Oh, newsflash. Home prices spiked during COVID-19, and then the Fed's war on inflation sent mortgage rates surging. The 1-2 punch has made it a historically unaffordable time to buy a home. It's been a weird combination. Mortgage rates rose substantially, but so did home prices. And again, we were talking about that earlier in the stream where it's very rare for those two things to occur at the same time. Usually it's one or the other. Usually they're opposite of each other. So as mortgage rates increase, typically prices decrease, but we did not see that. It's been a weird combination. Mortgage rates rose substantially, but so did home prices. That typically doesn't happen, said Gapin. The supply of homes cannot keep up with demand. Prices have had nowhere to go but up. Bank of America expects home prices will climb by 4.5% this year and then by another 5% in 2025 before eventually dipping by 0.5% in 2026. I wish they would have elaborated on this a little bit more. I would really be interested to see why they think home prices are going to dip by 0.5%. Now, that does bring some relief, but we're talking about 4.5% this year and then another 5% the year after that. So home prices are still slated to go up a smidgen, right around 10% over the next 2 years. That is not an insignificant amount of money. In fact, in my area, that means that home prices are slated by Bank of America's prediction. Average price in my area is a little over $900,000. So that means that homes are going to go up by $90,000 over the next 2 years, which is a lot of money. And Obviously, that means your down payment is going to go up. Your monthly mortgage payment is going to go up. It's all going to go up. Lock-in effect could persist for 8 years. One major problem hurting supply is the lock-in effect, which we just kind of talked about. People who already own their home are effectively locked into their property after refinancing or getting a mortgage during the pandemic when ultra-low rates were available. Buying now at current rates would require them to pay hundreds of dollars more per month on interest alone. Plus, home prices have gone up. For many, it just doesn't make sense to move. And because those homeowners are not moving, the supply of existing homes on the market is limited. And this is absolutely true. Typically, most of the time, when people move, when people list their homes, it's not because they have to, it's because they want to. Of course, there still are things, and we've talked about it in the previous article, the people will have to move for some reason or another. However, usually that's not the case. And historically in the past, people have moved because they wanted to go try living in a different neighborhood in their city or a different city altogether, or they wanted to upgrade from the 3-bed 2-bath to the 4-bed 3-bath or the 5-bedroom home. Or people went, what, I have a half-acre lot, it's too big, it's too much work, I want the same size house, but I just want a smaller lot, I don't want as much to take care of. And in this market, that's costs a lot of money. Previously, when mortgage rates just hovered between 4 and 5%, didn't really move a whole lot, moves were very lateral. You could move and really wouldn't make a difference. Wouldn't cost you a lot of money out of pocket because you'd sell your home, make some money from that, put the money that you made into the down payment on the new home. Your mortgage rate was probably within 0.5% of what you had in the other home. So your interest payment is roughly the same. So all in all, very easy to move around laterally. And that's how we have those chain reactions of people moving from one house to the next, opening at one house, opening another house, allowing people to buy them, freeing up rentals for the new people. And we haven't seen that happen. Why would I sell unless I have to? Said Gapin. Prices have gone up and the mortgage rate is a lot higher, so I'm content to stay where I am. Bank of America warns that the lock-in effect could persist for another 6 to 8 years, keeping a lid on supply during that time. Hence the title of this stream, Housing Market Locked for Years. I got news for you. If and I don't disagree with Bank of America, but if it stays this way for the next 6 to 8 years, it's going to be really tough on buyers. It's going to be really, really tough. Sellers will continue to have a little bit of a downhill road. But again, it's really hard to say. It's all so location based. Real estate is hyper local. I mean, hyper local. Not even just like my state or my county, but the town, and even neighborhoods within the town can have different turnover rates. So it's important to realize that this might not apply to every market. Again, we're seeing some of the what we call pandemic boom towns. We covered this last stream. Some areas of Florida, some areas of Texas, some areas of Idaho, mainly Boise, areas of Tennessee, mainly Nashville, areas in some of these other areas that sort of drew people to them because they were affordable and you could work remotely. Well, those areas are the ones that are could have a little bit of a problem. Areas here in my area, the greater Los Angeles area, San Diego, Seattle, your major markets, they're gonna suffer from the lock-in effect because it's going to keep supply very, very low. That's because the mortgage rate of people who already own is historically low, and the rate for new buyers is elevated. Bank of America doesn't think that gap will shrink much for years. This problem helps explain why pending home sales fell in May to a record low, according to data released on Thursday. Pending sales tracked by the National Association of Realtors since 2001 are a forward-looking gauge of home sales that measures contract signings. They can't take their mortgage rate with them. David Lineker, who co-founded real estate giant Remax with his wife in 1973, said the lock-in effect means people who want to size up to a bigger home can't, and the next generation can't even get their foot in the door for a starter property. The move-up market does not exist. Again, that's the one we were just kind of talking about, how people that just kind of voluntarily want to move up, either because they want to upgrade their home, they want to, try out a different area or city. It's just simply not happening. Uh, Lineker agrees that the housing market is stuck, for now at least. We have to muddle our way through this for a period of time, he said. But Lineker urged first-time homebuyers to remain patient. Don't give up the dream, he said. And that's one thing that I would completely echo. It's not about timing the market. It's about time in the market. And I know this is one of these things, if you're watching out there and you're considering buying your home for the first time, I know that you feel like it is impossible. I know that it feels like a huge uphill battle, and you're not necessarily wrong. However, um, even though it's difficult, it's worthwhile in terms of creating generational wealth, long-term wealth. It's going to be expensive, and you're going to have to make some sacrifices, but you never have to worry about your rent going up. You know what you're going to pay every single month. You have control of your domain. Plus, you get the beautiful appreciation and benefits of owning a home. So I agree. Don't give up on trying to buy that home. You might have to sort of reevaluate what you look for in a home. Maybe it means shopping in a different area or for a different size of home, but stay with it. It's highly, highly worth it, and it will pay off in the long run. In theory, a flood of supply of new homes would help unstick the market. However, Bank of America expects housing starts, which is a measure of newly constructed homes, to remain flat for the coming years. And housing starts have still not recovered from the bursting of the housing bubble in the mid 2000s, which we've kind of talked about this before. A lot of builders got their clocks clean in 2008. A lot of them went bankrupt, and they just never came back. And that's why we have such a supply glut of housing, is because we just we didn't build enough homes for a very long time because builders got absolutely pummeled in the post 2008 years. Divide between the haves and the have-nots, and this is why it's really important that if you are thinking about buying a home, if you are able to stretch and sacrifice and do it, you should. Now, obviously, you should be able to do that comfortably. You don't want to overspend. You don't want to stress your budget. Obviously, you want to be able to afford the house that you're in, but if it means making some sacrifices, it's a good idea, because the divide between the haves and the have-nots is only getting wider, and it typically appears that the haves are the ones that own properties and the have-nots are the ones that don't. Unfortunate. The forecast for a stuck housing market cuts both ways. The spike in home prices has padded the net worth of existing homeowners and given them additional financial flexibility. But there are many Americans who are on the outside looking in. They'd like to buy, but can't afford to at these prices and these mortgage rates. The longer they're prevented from buying, the more time they miss out on wealth creation. This is a huge key. And again, I know it's not as easy as just snapping your fingers and buying a home, but again, that wealth creation is huge. It's kind of like compounding interest, and I think we can all identify this. I don't know if I remember in high school, one of my economics teachers, Mrs. Sakry, saying to me, "Hey, listen, you should go to the bank today after school. You should open up a retirement account, and you should just put in $20 a month in that retirement account, because if you do that, by the time you're age 60, you'll have, like, I don't know what it was, like $1.5 million or something ridiculous." And all the kids are like, "Well, that's a lot of money. We should totally do that." Nobody does. Nobody does. And then you turn around when you're 30 or 35 and you go, "Dang, I really wish I would have done that." Same thing with owning a home. It's the same exact principle. It's that principle of appreciation, growth. What the bank would give you is interest. So the more time that you wait to buy a home, the more time that you miss out on that wealth creation. In a recent Gallup poll, just 21% of Americans said it is a good time to buy a house, tied for the worst reading in Gallup history. An overwhelming majority, 76%, say it's a bad time to buy. What do you think? Do you think it is a bad time to buy a home? Do you think it's a good time to buy a home? What are your thoughts? Have you bought a home recently? Are you thinking about buying one? Drop a comment below. I would love to know what you think. Gapin, the Bank of America economist, said if the U.S. economy achieves the soft landing that he expects, meaning that inflation cools without triggering a recession, there is a risk that home prices will rise even more than anticipated. And again, we anticipated about a 4.5% increase. They're saying that if we don't have a recession, it could even be more than that. So again, it's not about timing the market. It's not about timing it for the market crash. It's not about timing it for rates to go down. It's not about timing it for when you win the lottery. It's about time in the market. And I know that this is a very stereotypical realtor thing to say. I'm sure I'll get hit in the comments for this, either now or during on the replays. But I get it. The narrative of real estate agents is buy a house now. It's always a good time to buy. And do whatever you need to do to get into real estate ownership. But I have to say, in my experience, both in my personal experience and in the experience I've seen in my clients, Well, that's not incorrect. It's always a good time to start building equity if you can afford it. So you have to understand you have to be in the correct situation. You obviously need to have a stable job with stable income. You need to have good savings. If you're in a relationship, whether that's boyfriend, girlfriend, marriage, whatever, domestic partnership, that has to be stable. So that you got to make sure that your goals are aligned with that other person, even if it's a friend or family member. Even if you're buying a house with Uncle Rick, make sure that you guys are on the same page about it. On the other hand, the durability of the recovery has been overestimated and a recession is on the way. Home prices could tumble and affordability would ease. But obviously, you don't want to go through a recession to have a better housing affordability, he said, which is this last sentence, it's kind of thrown in here as sort of like a little bit of an afterthought feeling, but it's absolutely true. A lot of people out there are rooting for a housing crash. What you don't realize is that when we have a housing crash, that's going to decimate hundreds of thousands, most likely millions of Americans. For a very, very large majority of people, their primary residence, especially in the middle class, which is about 60% or so of people, um, the primary residence is the biggest financial asset people have. It's the biggest one. And if something happens to that, that's a huge, huge problem for a lot of people. So I understand why millennials and Gen Zs are like kind of rooting for a real estate crash or like a major economic recession. But you also have to remember that wreaks a lot of havoc on a lot of people, and it actually might wreak havoc on you. I mean, what if we do have a recession, and what if real estate does crash? But because of that recession, what if you lose your job? Well, it's going to be hard to buy a house. So that's not going to help anyone. So kind of an important little tidbit there with on the crash hope front. So we have one more article to look at before we have two short video clips. This one is from Fortune. The housing market's lock-in effect could last into the next decade as mortgage rates stay high, even with Fed cuts, Bank of America says. So this is going to be kind of similar to the last article we read. You can see where I got my inspiration for the thumbnail of tonight's stream. Uh, the lock-in effect that has kept the U.S. housing market activity subdued probably isn't going away this year or the next year or even the year after that. Excuse me. It was hot today here. I don't know. Like I said, I'm in Southern California. It was about 95 or 96 today, so the ice water is really hitting the spot. The lock-in effect, yeah, we read that. It could hang over prospective buyers and sellers of existing homes for 6 to 8 years before finally going away, Bank of America warned in a note on Monday, locking down the market into the next decade. The wide gap between current mortgage rates and effective mortgage rates means most homeowners are unwilling to move unless forced, analysts said. Moreover, we do not expect mortgage rates to fall much, even if the Fed cuts as we anticipated. When borrowing costs were lower during the depths of the pandemic as the Federal Reserve slashed rates to near zero, homeowners rushed to refinance, which is absolutely true, leaving U.S. households with the lowest effective mortgage rate ever on records going back to 1977, according to B of A. If it is ticked up about half a percentage point from its trough, but the effective rate was still at a low 3.8% in the first quarter. As the Fed began hiking rates in 22 to fight inflation, current mortgage rates went higher as well. Now there's a big gap in rates, which of course leads to this lock-in effect. Earlier this month, a Realtor.com report said more than half of outstanding mortgages have an effective rate of 4% or lower, and more than three-quarters have a rate of 5% or lower. Meanwhile, the current 30-year fixed rate is still hovering around 5%. Again, if you've got around a 5% rate or lower, you're looking really good. And why would you sell your home to take on a 7% rate and probably at a higher price than what you would have paid for that home when you bought your previous home? It just doesn't make sense for a lot of people to move. Hence this lock-in effect. This right here, this is like the very definition of what the lock-in effect is and why we're having such a problem. With homeowners unwilling to give up their low effective rates, the supply of existing homes has been tight, and this year's spring selling season has been muted. Again, this is going to be hyper local. In my area, the spring selling season actually was okay. It's not bad. It's not anything like pre-pandemic, but there's certainly activity. There's houses coming onto the market, but they do sell relatively quickly. The good news is in my local marketplace, we are still seeing multiple offers. We are still seeing overbidding, but nothing to the likes of what we saw in 2020, 2021, and 2020 in the first part of 2022. Now, instead of 8 offers, 10 offers, 12 offers, or 15 offers or more, we are seeing, you know, 2 offers, 3 offers, maybe 4 offers. And of course, it also depends on the property as well and the price point that it's in. Um, Sales of existing homes hit a seasonally adjusted annual rate of 4.14 million in April of this year, barely budging in almost 18 months, B of A noted. The bank sees the pace staying relatively flat in the coming years, projecting sales of 4.1 million for all of 2024, 4 million in 2025, and 4.2 million in 2026. So we're not going to have a change in transaction volume, which is not good in terms of alleviating the lock-in effect, hence the title of the stream this evening. The U.S. housing market is stuck, and we are not convinced it will become unstuck anytime soon, analysts wrote. After a surge in housing activity during the pandemic, it has since retreated and stabilized, which is true. It has retreated and stabilized somewhat. Of course, again, all dependent upon area. With supply still constrained and demand still elevated from the pandemic-induced shock, B of A expects home prices to jump 4.5% in 2024 and 5% in 2025, before finally cooling off with a 0.5% uptick in 2026, where prices could surge another 5% in 2026 if pandemic-related factors persist, analysis warns. So could you imagine that over the next 3 years, we're looking at almost 5% per year, 15% over 3 years. Pretty crazy. And don't expect much help from newly constructed homes. The bank sees housing starts averaging a stable 1.4 million units in 2024, 2025, and 2026, with sales of new homes averaging 650,000 in those years. But others in the real estate sector think even a modest decline in mortgage rates could unlock a burst of housing market activity. Earlier this month, Compass co-founder and CEO Robert Refkin told CNBC that he would feel good about a 6.5% rate, but the magic number is 5.9999. I don't disagree. I think if we ever got rates with a 5 as the primary number, I think the market would start to loosen up pretty considerably. Although, if you lower rates, prices tend to go up. So, what do you do? That be marketing magic and would tell the world that mortgage rates are at a level where they should go and grab a property, he said. So again, just an interesting take on sort of the lock-in effect. I have one more thing. So I've got a video and then I've got the screenshot. So I want to show you this screenshot from this YouTuber. I like this guy a lot. His name's Jason Walter. He's an agent up in Sacramento. He's got just a tick under 100,000 subscribers. So he's got a pretty decent following on the YouTube. And the reason that I'm pausing this video is because this chart that he's showing is great. I went to go try to find this chart, and it's you have to subscribe to the website, and I don't want to do that. So we're going to take a freeze frame from his video. I'm going to make this a little bit bigger. So this chart is active housing inventory for sale compared to pre-pandemic levels. Metro shift between May 2019 and May 2024. So pre-pandemic, man, May 2019. Just go back to that time for a second. Pre-COVID, pre-crappy interest rates, pre-crappy housing inventory. Just boy, when the times were good, all the way to May 2024. Reason we're using May is because housing inventory lags, so we don't have June data in yet. So we're going to use May. And so this is showing inventory shifts over those kind of 5 years. So you'll see that according to this chart up here, the bar, the kind of the deeper, like the brown, the darker the brown means less inventory than 5 years ago. The deeper the sort of like teal blue color-ish, the more inventory that's available in those areas. So if you tuned into my stream last week or you watched the replay of it, you'll notice that I talked about Texas and Florida. And look at what's going on in both those areas. Almost every bubble in Texas, except for whatever this is. I'm sorry, I'm not a Texan. Any Texans in the chat, if you know what this area is, there's been a little bit of inventory crunch in this area, probably in the I don't know, probably 5%, 10% range. It's pretty beige, which is neutral. But the rest of Texas is blue, and some of it is deep blue. Austin is plus 35%. These two little pockets, huge inventory here. Surplus, inventory surplus here. Austin plus 35%. A lot of blue here. Same with Florida. Florida is like even more. I mean, Punta Gorda plus 61% in inventory in May 24 as compared to May of 2019. These are the areas that are ripe for a real estate deal. If you are looking to buy a property, and maybe it's not even for a primary, maybe it's for a secondary residence, rental or something like that. These are areas that if all you care about is a deal, look in these areas because the inventory is plentiful. We've got some areas in Colorado as well that are showing a little bit of inventory surplus, but not a whole lot. But your major areas, I mean, Phoenix is plus 4%. Arizona was also kind of one of those boom towns, pandemic boom towns to a certain extent because of the affordability, but nothing super great in terms of inventory increases there. But the rest of this map, I mean, the entire like Midwest, the entire kind of northeast coast and much of the East Coast. Remember, all this brown that you see, that's all inventory being lower than it was pre-pandemic. And some of these areas, like, I mean, the New England, the New York, the New Jersey, I mean, this is like deep brown. I mean, we're talking 50% less inventory. Same goes for the West Coast over here. I mean, look, LA, minus 45%. Folks, there is not going to be any price relief in these areas. There's not going to be a crash in any of these areas. It's not going to happen. All along the West Coast, same thing. It's either neutral or an inventory deficit. Of course, the hot spots in your Santa Barbara. This is the Santa Barbara kind of area, the Ventura area here. This is kind of Sacramento, Fresno. Your Palo Alto, your San Francisco, a little bit of help there, but even that's coming back a little bit in terms of inventory shortages. So, a lot. One thing I was surprised about this is Idaho. I thought Idaho, I'm not sure what this is. I believe Boise's somewhere over here. My geography is not the best, but Idaho I thought would have a lot more blue, and it does not. I was a little bit surprised by Colorado that there's some blue there, but overall, this area, the southeastern seaboard, your Florida area, there is some pretty good amounts of inventory supply compared to pre-pandemic levels. So this is the type of thing where those areas could certainly see some pricing relief. I don't think it's going to constitute as a real estate crash. I suppose maybe in some of those areas, but overall as a whole, as we can see in a lot of the major metropolitan areas, I mean, even in not the deep south, but sort of this southeastern portion or the southeast coast, there's not going to be any price relief here. It's going to continue to be competitive for buyers. So that was just an interesting graph. Again, this is from Jason Walters, really good analytic guy. He is a realtor. He is a lender. He's an ex-CPA. So he's got some good knowledge. His channel's full of a lot of just really good stats and market data. It's a lot of numbers, though. It's a lot of graphs, a lot of numbers. It's a little sort of on the nerdy, geeky side, which I kind of like a little bit, but may not be for everybody. The other thing I want to share is this video. Okay, so this is from Fox News, and they're going to talk about stuff that happened under the Biden administration. I just want to preface this with it's not a political stream. I don't get political. I'm sure everybody has their thoughts on whatever administrations do, pros and cons, whatever. But really what I want you to listen to is Kevin O'Leary, really smart guy, knows his way around finance. This is not a hugely long video clip. It's only about 3.5 minutes. But I saw this and I just thought it was interesting. And I thought it was interesting to get his take on what he thinks is going on with the market. So let's listen in.
All right. So what, if anything, right now can help to bring these housing costs down? Let's ask Kevin O'Leary, chairman of O'Leary Ventures and Shark Tank investor. It seems what we are seeing on the part of the administration and beyond is this announcement to boost housing supply by throwing money at the problem. Isn't that what got us here in the first place?
It's not going to work. That's going to cause more inflation. We've been throwing a lot of money at a lot of things. Think of the CHIPS and Science Act, and Inflation Reduction Act ended up being very inflationary. That's printing a lot of money. So that idea isn't going to work.
So I like how he just kind of like comes right out and is like, "No, it's not going to work. It's not going to work. Can't just throw more money at the problem." Which, that's a very typical government thing. We don't know what to do. We're gonna institute a tax, and then we're gonna throw money at it. And it just doesn't ever seem to work. It doesn't ever seem to work with homeless housing. It doesn't seem to work with quality of roads. It just doesn't seem to work for infrastructure. It doesn't seem to work. So I just thought it was interesting how it just comes out kind of guns blazing. It's just like, nope, not going to work.
So what do you do?
Good question. So what do you do? What is the fix? And there is no magic fix, as Kevin will elaborate on.
So the key to housing is to understand that the cost of owning it really is about interest rates and mortgage rates. And just 2 years ago, they were 3.5%. Now they're 7 to 8%. That's the biggest problem. And housing is one of the pain points in inflation, the other two being energy and food.
And that's another good point, is that, we say, oh, inflation is sticky. This inflation is sticky. It's hard to get rid of. We can't get rid of the inflation. Well, part of that problem is because housing is so expensive. So it's kind of a vicious circle. Housing is expensive, so inflation stays high. Well, when inflation stays high, the Fed's not going to reduce rates, and when you don't reduce rates, houses stay expensive, and the prices stay high, and the affordability stays low. Well, it's kind of this vicious cycle. So it's a difficult problem. So I'm glad you kind of made that point.
But the only way to make this work is to increase supply. And the problem, which is kind of unique to our situation now and really causing pain, is if you have a 3.5% mortgage, the average on that mortgage is still another 3.5 to 4 years. So if you have that, you're never going to flip that house to one where it's 7.5%, regardless of what you think about the house. It's too expensive to make that move. And if you did, you'd lose about 25% of the floor space for the equivalent. So we're really stuck in that phrase.
So he's basically saying that if you did move, you're gonna have to take a huge cut on the size of the house, because typically, the size of the house is a function of the cost, or the cost is a function of the size of the house. So he's saying, like, even if you did want to give it up, you're gonna have to sacrifice to a much smaller home, or perhaps a home in a less desirable neighborhood. And I want to go back really quick, because they had a good kind of chart up on the screen when they gave the different. Yeah, here we go. Existing home prices up 38%, and of course, it says cost of housing under Biden. I don't really think. I don't know. I don't know. I don't think it makes a difference if who the president is. A lot of this had to do more with pandemic-related stuff, but this is the news doing what the news does. So forget that. Just look at since January 2021. Existing home prices since January 2021 plus 38%. Rent plus 22%, mortgages plus 142%. So there are some people out there that go, oh, see, renting is more affordable than purchasing. Well, yes and no. Rent might save you more money up front, but once you're in that home, it doesn't matter how much the prices go up, because you're locked into your home, you're locked into that payment, but rent will continue to go up. Let me try to find the spot that we were at a little bit here.
Stuck in that phrase. It's a really, really unique problem we haven't seen for a long time, if ever, because it's a problem caused by this rate increase in a very, very, very short period of time. Now, one way to solve it would be the Fed would also reduce rates at a very quick rate. Remember, just a year ago, we talked about 7 rate cuts. That never happened, not even one. And so really, we're stuck in the overall policy situation of simply printing too much money. And this is how you pay the price. Now, this is not great for the incumbent in the White House. Housing inflation never is, but there's nothing you can do to change it by November. Nothing's going to change by November now. It's in. I mean, that's all you can do. And so hopefully the Fed will cut rates at some point, but I don't see it happening this year.
But saving.
Yeah, same thing. I don't know if I see it happening this year either. I mean, I just don't think there's enough data, and the Fed and Jerome Powell have been very clear. They've been very clear, and I'm glad that they've kind of stuck to their guns, because if we had interest rate reduction, I don't even know how much it's going to solve. And the economy is, we're trying to avoid a recession. So we're trying to slowly, ease the brakes. And when you lower the interest rates, you're actually taking your foot off the brake. And depending on how much they cut rates, or if how much they did cut rates hypothetically, not only are you taking your foot off the brake, but you could even be pressing the accelerator a little bit, which is probably not what we want to do right now. So the Fed has been very cautious about messing with rates because of inflation. And so I agree with Mr. O'Leary. I don't think there's much that can be done right now.
Saving up for that down payment is harder, arguably harder than it has ever been with those high prices. It is tough to sock away money when you're paying 40-50% more for gas prices today than you were 3 years ago, 20-25% more for your grocery bill. All of that is it's just all.
Yeah, I don't disagree with her. Obviously, if the cost of things go up, it's harder to save money. But let's get real. I mean, an average down payment on a house, let's just say the housing median price is $40,000. Even if you want 10% down, that's 40 grand that you got to save up. I don't know if paying an extra $15 at the pump is going to make a difference. I don't know if paying an extra $20 at the grocery store is going to make a difference. Every little bit helps. But at the end of the day, we need more housing supply. I think that's a little bit of a scapegoat on the news anchor personally, just trying to drum up the fact that stuff's more expensive and blaming it on that. I think at the end of the day, housing is just too expensive. We need more supply, and we need to motivate people to move. And I don't think it can happen through any type of $10,000 first-time home buyer credit, tax incentive here or there. I mean, it would have to be a major thing in order to bring some relief to real estate pricing.
Feeding into this affordability crisis, Kevin. Real quick final thought.
Well, the rule of thumb is very simple. If you're spending more than 35% of your free after-tax cash flow on your salary on a mortgage, you're not going to make it. Yeah. So what that really means now is either both of you work, both partners work, if the average salary is $85,000, yeah, or you start thinking about a house 40% smaller.
Yeah. And you hear a lot of that out there. When you look at how good the jobs market it is and how low the unemployment rate is, a lot of folks are saying, well, we're out there working 2 jobs to pay for the increase in prices. And that's a very real thing. Kevin, great to have you. Thank you so much.
Take care.
Click here to subscribe.
So interesting. Really interesting and to hear from Kevin O'Leary, who, smart guy, done a lot of investing, knows the markets, knows real estate. To him, it seems pretty clear there's not a whole lot that we can do. There's not a whole lot that can be done short term to fix this. And unfortunately, I think this is going to just be one of those things in history where we look back and just go, it was a little bit of a tough time. I think it's going to be really similar to how we look back at a portion of the 80s where there was just really high interest rates. There was inflation. It was just a really difficult time, especially in the real estate world. And I think we're headed back for that type of same thing. I don't think there is reason to believe that there's going to be a housing crash anytime soon for a couple of different reasons that we've already addressed in the stream today. But I'm always interested to hear your thoughts. So if you think there's going to be a housing crash, sound off in the comments. Let me know. I also like to know where you're watching from and what you're seeing. Again, I'm just one real estate agent in Southern California, and I just work in a pretty small marketplace. So certainly not aware of what's going on in your neck of the woods. So let me know what you're seeing. If you enjoyed the stream, please drop a like. I appreciate it. It really helps out my channel. And consider subscribing. We go live every Wednesday at 6:30, and we're talking about real estate matters. And I'm also here to answer your real estate questions. So if you have questions, whether or not it's something we're talking about, or if it's a scenario that's unique to you, if you just want to ask an actual real estate professional and not just punch it into Google and actually get a real answer, I'm always happy to take questions, whether that's in the comments or through a private message. Whatever you prefer is fine. So I hope you guys all enjoyed the stream. As always, I really hope that you enjoyed the content that I was able to deliver. Have a phenomenal 4th of July. Hopefully you've got that 4-day weekend lined up and you're doing something fun. Have fun, be happy, be safe, and I'll see you all again real soon for the next stream. Have a great day.